fortnight in the London session. Now you're using it again. Notice that we're using the high of the volume imbalance on the daily chart because it's a higher time frame PD array. It trades to the high of it. And does it hold that candlestick? Because it opened here and went all the way up here. At one point, there was a big green candle like that. And then it does this, comes down here and closes. Where does it close? Below consequent encroachment. That's this level right here. So now the immediate next candle, anywhere below that midpoint, that consequent encroachment, anywhere in there, but above the low of the candlestick's high, which is the framework of the low of this gap framed on a 1 minute chart. You can enter here. If we were not seeing elevated volatility, you could place the stop loss one tick above this high. But because, listen, folks, listen, man, because the volatility is so extreme, because the likelihood of the ranges sharing the previous candle's range, you have to go outside of the immediate smaller time frame price range, which is what we're identifying here. So you got to go back to that 1 minute chart and use the high I showed you. You can't try to trade with these super tight stop losses and not expect to get stopped out a lot. You're going to get stopped out a lot. And commission costs add up. Losses, even though they're small, they will add up. And the frustration, the compounding frustration of you taking small paper cuts, they still hurt, don't they? As soon as you put your hands in something that has alcohol, or if you put your fingers in something that has like a citrus juice, like an orange or a lemon, and you have a paper cut, you'll find it. Eat crabs and get a little slice in your finger. You'll know all the little wounds because it's painful. It gets in there and irritates it. So it's hard to focus and concentrate, taking and trading new risk when you have these compounding effects of pain. So you want to enter in the lower half, use the higher time frame where the setup formed, use that for your stop loss. That means, yes, you're probably going to trade with less contracts. And that's a good thing right now. You're not trying to make a lot of money in a very difficult market condition. So many of you want to come out here, and I'm going to tell you what it is, okay? So many of you want to come out here just so you can say to an old guy like me, say, don't listen to ICT because he says don't trade on Mondays. And look what I did. I made this. Motherfucker, show me your entire show. Don't just tell me after you did something. Tell me what you're going to do beforehand. Tell me the level you're going to trade to. Do all that stuff. Okay. Everybody wants clout. They want to come out here and say, this guy or that guy says, don't do this and don't do that. How about stay in your lane, make your money, hang out with your friends online, and stop being an asshole? How's that? How's that work for you as a suggestion? And stop charging money. Oh, but that ain't going to happen now, is it? So everybody wants to be a hero. Everybody wants to be a smartass. Everybody wants to reinvent the wheel. They want to coin something. They want to prove a logic is no longer valid. They want to prove there is no algorithm or there is a change in the algorithm. And everybody else is wrong. Okay? Trust me when I tell you that. That's the one thing you can know for certain that I'm right about. Everyone else but me is wrong. Okay? There you go. Nice fuel for the weekend for that. Social medias. So the market uses this area for entry, and the immediate run would be here. So now I know some of you are thinking, that's not enough, ICT. It's enough when you're working with ample size of an account. You've been doing it for a long period of time. And this right here will tell you whether or not you can make money on the trade. Can you make money with this run here? That low is 68. You're entering in around 78. That's 10 handles. Can you take that target there and say, I'm comfortable with it? Some of you might. There's a lot of people on the internet that just simply look for 10 handles. Trades by Matt does it all the time. And he's taking payouts. So I'm not going to knock 10 handles. I'm not going to say that that's a bad thing. Me personally, I would like to see a minimum of 15 handles. So as luck would have it, you have something over here. So now we're closer to that 15 handle run. So getting short up here, aiming for that pool of liquidity right there as a first primary scaling opportunity to take a partial. That would be viewed like this. There's sell side. Entering on a premium. Premium to what? That sell side liquidity pool. And then we have that low. Now, this low is more likely to be a factor because what? What's this dotted line here? That's consequent encroachment of that volume imbalance on the daily chart while being bearish because it rejected the recent highs on the daily chart after NVIDIA earnings. So, consequent encroachment is always a draw. Always a draw. It's always a draw. And if we're up here, first partial, doesn't mean you have to take it, but it means that once we get below it, then we want to see displacement. If you're not going to take a partial and you're only trading with one contract, wait for displacement. What does that look like? That. We could create a short-term low, then it dives lower, closes, the next candle starts to run lower. You can see that is displacement. So now you can, instead of taking a partial here, you have one contract, roll your stop loss from where it started over here down to just above that high. So what I just taught you was how if you're only using one contract and you can't take a partial because if you take a partial, you're closing the only existing position size you have. So you wait for a key low, which is what I just mapped out here. Not this one because I want at least 15 handles or I won't take the trade. Once it takes that low out where a partial would be taken, that displacement affords me the opportunity to then move my stop loss just above that high. What high? This candlestick, because this is the displacement candle. And then as it moves lower and lower and lower, we want to see it gravitate to consequent encroachment, which is that big red area from the daily chart. That's that volume imbalance. That's the draw. When it does that, okay, we anticipate it not just trading here, but there's liquidity resting below that. So now we can do this. That's the sell side liquidity pool that you could take a partial or a full closure or wait for it to use that level and displace away from it. Where is that? There. It trades above it here a little bit. Your stop loss, if you were trailing it and you only had one contract, would be here. You're not in jeopardy. You're anticipating this. The market rolls through. Once it leaves this key level on the downside again, you're looking for displacement. Is this displacement? No, it's not displacement because it created this low right there. That low needs to be pierced to the downside. Does it do so? Yes. Does it do so and leave it as a SIBI? Yes, it does. So when it does this, then you can move your stop loss from here down to this candlestick's high because that's the leg that starts the price run lower. This run is sell side delivery, not sell side liquidity. It's the running lower of price action. So that means you put your stop loss right here. So now what you have done is you've captured very close proximity to that low where you would have closed your trade for full target. Remember, you're on a very small time frame and you're using a micro structure approach to trading these price legs. Once this does this, you've afforded getting stopped out, holding the position in case it gives you a little bit more room to run to where? The low of the volume imbalance. Why? Because we're bearish. This little gap in here gets traded up into here and then runs to the low. That would be your next objective. So you can close it there and anticipate some measure of retracement. Why? Because this is a higher time frame daily volume imbalance. It may come back up to consequent encroachment of it. But if we're bearish, we want to see it not do so. Here's where it trades up to here and then rolls over and goes lower. But I wouldn't have caught that. Stop being fucking greedy. So, Michael, please stop cussing. Don't come to my live streams because it's probably going to come out. We're talking about trading. Okay. It's going to come out sometimes. So if you are looking for a larger price run, you can see anticipate it retracing back to consequent encroachment. But then if it displaces outside of and below this low, because the displacement has to go before below a key low or above a key high. Is this displacement here? Yes. The market trades back up to the low of the volume imbalance on the daily chart, that big red box, and then it moves lower. Once it displaces below that low here and it closes, you can move the stop loss from here down to that candlestick's high. I'm teaching stop loss management. Can you teach stop loss management ICT? Sure. Here you go. And the market trades lower and eventually dives even lower and moves into those targets I gave you this morning where it was gravitating towards an old, smooth little area. Okay, we're getting close proximity of those same time frames. Now, I wasn't on the chart at 5 o'clock in the morning with you all, but you can see how that would be useful here. And once we had displacement below this low leg, that you could trail your stop loss from there down to that candlestick's high. And then you're strangling the position because it's already moved so far outside of the level you anticipated as just a reasonable target. So that's high frequency trading on a lower time frame, stop loss management, and hopefully you learned a little bit there. Don't worry, it's not the only time I'll talk about